Hello, students, and welcome to this introduction to management accounting. This will be a lecture on basic concepts around management accounting and then, of course, serve as an introduction or a first class. I always like to start my lectures with a quote of inspiration, and this one is a quote by one of my favorite philosophers called Aristotle. And he said, "We are what we repeatedly do. Success is therefore a habit." I really like this quote because it reminds us that you can be successful if you are willing to put in the work. So the purpose of this lecture, again, it is just to establish a basic understanding of what cost and management accounting really is, and to introduce the key concepts that will form the core of the module going forward. So if you do not understand these basic terms going forward in study unit 2, 3, etc., you will be having a hard time to understand it. In order to start, I would like to draw parallels between, management accounting and something that you are already familiar with. And the accounting that you have done in the past is called financial accounting. So you've done financial accounting in the first semester, you have done financial accounting at school, and you should be quite familiar with the concepts. So in my opinion, the main difference between management accounting and financial accounting from a practical point of view is retailing versus production of inventory. And I have put two different business logos here to serve as an explanation of what I mean by this. So the word retail means that you buy goods and then you sell them for more. And you would have covered what we call markups in financial accounting, where you can have a markup on cost price, you can have a markup on the selling price, and normally that is retailing. So if you think about a business like Spar, they sell groceries. So they buy the groceries from a supplier, and then they add a markup and they sell it to you on an everyday basis. So that is retailing. Management accounting is applied in situations where businesses produce their own inventory. So they don't buy something and sell it for more, but they actually produce what they intend to sell. And a very good example of this would be Sasol. So if you are familiar with Sasol, it is a very large production company in South Africa, and they produce petrol. So they make petrol for us to use so that we can drive our cars, trucks, airplanes, etc. And they make petrol, they produce it, and then they sell it at a markup. So, as you can now already deduce, it's very important if you are producing your own inventory to keep track of the costs that you incur to make this product, because you don't want to make a liter of petrol for 10 Rand and then sell it for 9 Rand. So, you need to keep very careful track of the costs in order to produce it. But this is the main difference. When we have retailing, we mostly only apply financial accounting, where you buy things and you sell it for more. If we do management accounting, we are concerned with manufacturing whatever we will sell in future. If you look at the textbook, I have copied this from the textbook, you will find that there's also some other differences that are discussed between management and financial accounting, and this is set out in quite an interesting way. They have some key questions that they ask, and then they explain how it relates to the two different types of accountings. So the first question is, who uses the information? So from the word management accounting, you can already understand, or you can already derive at a conclusion that it is mostly used by managers, executive directors, CEOs. It is used by management. You will find that in the textbook they also say investors. I only agree with this partly because investors in small businesses, so if you maybe have a private company, yes, the investors will know about the management accounting planning that's happening. But on larger scales, if we look at listed companies, investors will never see, for example, the budgets of Old Mutual, right? So it also depends on the business size whether investors are involved in the management accounting process. For financial accounting, we typically have users who are just external to the business. So that would be investors, your creditors, government agencies, that would be SARS because they want to tax you. Any external stakeholder who is interested in either investing in the company or who has already invested in the company by, for example, being your supplier, or you are their supplier, thus they are your customers. So financial accounting used by external people who are not necessarily directly involved in the business. Then the next interval says level of aggregation. So this is basically answering how do we account for the different accountings. So for financial accounting, you will find that information is presented at the end of a financial year for the business as a whole. So normally we have, if you would, for example, Google the financial statements of ShopRite, you will find consolidated statements of profit or loss, consolidated statements of financial position, and they account for everything that the whole business has, all the assets, all the liabilities, the retained earnings for the whole consolidated business. And it is just a set of statements that encompass everything about that business. If we look at management accounting is a bit different because here we account for different segments of a business or different departments. So you will find that the plant manager will only focus on his department and he will only do planning and budgets for his department, and the next department will set up their planning, and the next department, or with product lines, we only this manager will only plan for product A and this manager will plan for product B. So there's a lot of segregation in the level of reporting because you only care about your immediate business segment that you are managing, thus management accounting. What type of information is presented? Well, in financial accounting, we work with financial data. So typically they tell you the rand value of what things are worth. So we have 25 million rands worth of assets. Also, if we set up financial accounting statements, we also work with financial data referring to things such as receipts, a proof of EFTs. In the olden days, they used checks. I just received news that Standard Bank will no longer be allowing for checks to be issued, so that's really phasing out. But typically, that is financial data. If we talk about management accounting, we are looking at economic and physical data as well as financial data. So in management accounting, we are still concerned about what things will cost. So we also care about how much are we going to pay to produce our inventory. It's still important because it still has a financial aspect. However, we also care about economic and physical data. So if I talk about economic data, that would typically be something such as a business cycle. If you have done basic economics, you would have learned about business cycles, and business cycles tells us, how our economy is performing as a whole. So are we in a recession? Are we in a depression? Are we in a boom? And if we plan as managers for our business segment, we want to know what will happen in the future, because management accounting is very futuristic. We plan, we care about what will happen at some point in time in the future. So we want to know, will we still be in recession next year? Because if the economy as a whole is not doing well, we might want to reduce our production because we don't want to produce units and invest capital in making units that will not be sold and that our consumers will not be able to afford. And then also we are concerned with physical data because we produce, again, our own inventory. So we want to know what is the material needed to make one unit of whatever we are selling. So suppose that I am making wooden tables. I want to know, to make a wooden table of a standard size, I need 3 meters of wood. Or I want to know if I produce goods, it's normally done in a process. So I have direct material, I have then some kind of work in progress account, and then I have finished goods. So I need to know about 40% of the goods that we are producing are still work in progress. 60% of the goods had been completed. Of the completed goods, we again sold half of it. So it's important to understand the physical flow of the things that we are producing, which is then, of course, our physical data. Then the next interval says, is it regulated? What are the regulatory expectations? And this is really something that causes me to enjoy management accounting so much. And that is the fact that management accounting has no accounting standard. There is no written specific book or rule that we have to follow. The only thing that is set out is that managers need to act ethically. So you are not supposed to lie about the units that you are producing, the materials that you are purchasing. You still have to account for everything in a truthful way and be accountable for the decisions that you have taken. But there's no written rules that need to be followed. If we are looking at financial accounting, there's a whole lot of rules that we need to follow. We have our international financial reporting standards. We have our international accounting standards. We have our Companies Act. And I think the newest one is number 73 of 2011, which sets out a whole lot of rules about the publication of financial statements of listed and public companies. So it's an awful lot of rules that need to be followed, and there is a very clear framework. Whereas with management accounting allows the manager to set up a framework so that he can ethically manage his business segment to the best of his abilities, and that allows us to be creative, not dishonest, but creative in how we try to reach our goals. Then characteristics of the information. With financial accounting, they say that the information is very, very factual. It needs to be objective, reliable, consistent, and accurate. So yes, I agree with this, because going back to financial data, it is factual because you have issued a receipt, and then we issue receipts in a sequence, and all of them are numbered, and you cannot say a transaction happened if there's no receipt for it. So it's factual in terms of you need proof. It is reliable in terms of you need proof. Here it really happened. Here's the amount. Um, Accuracy, yes, there's always a margin of error, but we need to, as far as possible, account for our financial accounting transactions accurately. And then, of course, the auditors will come and express an opinion on whether our financial statements are free from material error. So it's very factual, it's very precise. You need to be consistent. You need to set up your financial statements the same way every year. So again, a lot of rules. With management accounting, again, the focus is in the future. So we try to use information that we know about in the past and what is currently happening in the world, and we try to predict the future. We want to plan. So estimates plus factual information is needed, but the factual information will relate to the present or sometime in the past, and we use that to make the best possible estimates of a future value that we will think will closely realize. Then the time period, again, for management accounting, we focus on the past and the present. We use that information. We try to predict the future of our business and how we will be able to reach our objectives in the future. Whereas financial accounting is very historically based. So all the transactions that we capture in financial accounting already happened in the past. It already happened at some previous date. If you look at the publication of financial statements, the Companies Act allow financial statements to be published within 6 months after the financial year of the business ended. So let's say that my business has a financial year end of 31st December. I only need to publish financial statements by June. So by the time that you see financial accounting statements, that transaction can already be 18 months old. So it's historically based. Then frequency of reporting, there is an emphasis in financial accounting that we need to report every 12 months. So we report every year. You will find that a lot of businesses also halfway through the year, they also publish financial statements. They call it 6-month statements or half-year statements. But the emphasis in terms of your framework, your IAS 1, your Companies Act, it requires a publication at least every 12 months. With management accounting, we are continuously planning because the future can be defined in different ways, because next week is the future, next month is the future, next year is the future. So we are continuously planning for some period of time in the future. So it's an ongoing process, and it never ends. We need to work at it on a weekly basis, on a monthly basis, whatever it is that we are planning for. then why are we doing management accounting? If we look at the bigger picture, why is management accounting needed in a business? Well, it's needed for three reasons. It is needed for planning, it is needed for control, and it is needed for decision making. So again, financial accounting focuses on historical information. Management accounting worries about what happens in future. So it enables us to plan and describe, but we set out all these objectives for the firm, but how are we going to realize them? If you have done basic entrepreneurship, you will know that every business sets out something such as a mission and a vision statement, some long-term objectives, some short-term objectives. So that is where management accounting comes in. In terms of finance, we need to plan how we're going to reach those objectives that were set out. Then to exercise control. One of the more important steps in management accounting is that we plan and then we collect the actual results or the factual results, which is basically our financial accounting statements, and then we compare. So I will, for example, set a budget for 2021. Then the financial year of 2021 will happen and the financial accountants will set up statements. Now I will look at my budget that I set for 2021 and I will look at what really happened in 2021 and then I will compare. And I need to find reasons why were the sales less? Why was cost of sales increasing? Why did labor cost exceed the planned amount? So I need to go and exercise control by finding reasons why our budget did not realize. Because even if we have a plan, in real life, it doesn't always realize. Then decision making. One of the problems in finance as a whole is that we always have alternatives. So if you have, for example, you can look at this on a small scale or on a bigger scale. Because if you have 10 Rand, you can buy airtime or you can buy, let's say, a packet of chips for yourself. So there's already two alternatives for you. And this problem translates into business as well because of this issue of scarcity. We don't have enough money to just fund everything. So we have made an X amount of money. Now we need to decide, are we going to fund project A? Are we going to buy asset B? What will we do with it? So management accounting is quite important in the decision-making process because we always have alternatives to choose between and we need to go and weigh up the pros and the cons so that we can make the best possible financial decision for this business and the decision that will affect this business best in future times. Another principle that is very important to understand, and this is why I said, where do we start? This is a very important principle to understand in management accounting, and it is that management accounting relies on an important assumption. And I tried to put this assumption in a picture so that you can visually observe it. And that is that we basically have a whole business, right? So the whole business would be this blue block. And management accounting assumes that there are two main business segments. There's a manufacturing segment, and manufacturing takes place in the factory, and we have a selling and admin segment, which takes place in admin offices that are separate from our factory. So you will not find sales reps in the factory. You will not find administrative receptionists in the factory. So there's an assumption that we split these two. So we incur manufacturing costs in the factory and we incur selling and admin costs in administrative offices. If we look at our non-manufacturing costs, these costs are called period costs, and they are basically these selling and admin costs. So admin costs would be, for example, the cost of having a receptionist, the cost of your accountant. That is typical admin work. Then we also have selling costs. So selling costs would be your marketing projects, the sales commission that you pay to your sales representatives, because even if we have now produced this nice product, we need people to go out and basically outsmart our competition and tell our consumers about the product and sell the product to our consumers. So that is the function of having a sales department in the business. So such costs do not affect the production process. So if we are calculating our manufacturing costs, we do not get these two mixed up. Look at these two bubbles. They do not touch. We keep them separate at all times. So the selling and admin costs or the period costs, they are not included in our production cost or our production process. Such costs are listed in our income statement. So the costs, the salary of the receptionist, the salary of the accountant, the cost of printing marketing flyers, all of those go to the statement of profit or loss, as you would know it now. That's the new term that it is called. Then we have manufacturing costs. So manufacturing costs are the costs that relate to our manufacturing a product. And there are three different manufacturing costs that are very important. It's direct material, direct labor, and manufacturing overheads. Those are the three manufacturing costs that you will see in every study unit that follows this one. So let's talk about each of them. Direct material, what does that mean? The textbook says that direct material it's the raw materials that are transformed in the production process to form a finished product. The direct material forms an integral part of a finished product, and it is directly and explicitly included in calculating the cost of a product. So I've put an example here, and this is a Nike school bag. It's very, very nice. So if you look at this Nike school bag, the direct material will obviously be the durable materials that we use to make it. The zips that you can see on this bag will be direct materials. So direct materials are explicitly observable in a product. If we have, for example, a plastic chair, plastic will be the direct material. If we have a wooden table, the wood will be the wood will be the direct material. So direct material is included in calculating the cost of the product. Something that's quite important is that we need to remember that direct materials also include other costs, such as delivery costs and import duties. Very important. If you have a delivery cost and your direct material is delivered at a plant and the supplier delivers it at a fee, then that delivery cost increases your direct material value. It is capitalized to direct material. Why is that? Because it is considered an integral part of getting your hands on this material. And this is why people complain when the petrol price or the diesel price increases, because then they say everything will be more expensive now. Yes, because each time a business buys inventory, they capitalize the delivery cost directly to the direct material, which makes the material expense higher, and the cost of calculating the product is then consequently also higher. Something else that's important is the import duties, especially in third world countries such as South Africa. We tend to import a lot of our direct materials from places such as China. A lot of steel that we see in South Africa came from China. And although it helps us to get our hands on cheaper material to have a cheaper product, the state or the government wants to minimize this because we are crushing our own businesses in South Africa. So they basically charge a little bit of a tax, an import tax, in order to make sure that people don't only import, the things that they need and that they want to sell and that they want to transform in their production processes. So the import duties are also added to the direct material, and thus if you import things and the import duties are high, the direct material is more expensive, and again producing the product will then cost you more. If we look at direct labor is basically everyone who is involved in converting the materials into finished goods. So if we stick to our school bag example, the direct labor would be the ladies who actually sew these bags. what do you call them? Seamstress? I don't know. I think it's called seamstresses. I don't sew. I have no clue. I do management accounting. But let's suppose we call them seamstresses. These will be the direct laborers of making the bags because they sew the bags together and make sure that they look right and that they are of the right quality, and they are directly involved in in the making of this product. Again, the direct labor, it's an integral part of the cost of a unit to produce. The last type of costs that we have are manufacturing overheads. And manufacturing overheads are indirect costs that exist because of the manufacturing process. So again, you cannot explicitly see these costs, but they must be incurred in order to deliver this specific product. So that would be, for example, the rent of a factory. If you have no place to make a product, you're going to be in trouble. It will be the cleaners, because the cleaners don't make the school bags. However, they are still necessary because somebody needs to clean up. Again, supervisors, they don't make the school bags, but they come and check that the ladies who sew it are really busy. Quality controllers, again, they don't make the bags, but they come and check every 10th bag to make sure that the quality is right. And think about things such as electricity. The ladies cannot sew if they don't have electricity. We need water. So all of these are indirect costs that are not necessarily explicitly observable in a product, but if they are not incurred, then they will not be able to run this production process successfully. Manufacturing overheads are further divided into three subgroups. We have fixed overheads, variable overheads, and mixed overheads. Fixed overheads are overheads that remain constant, normally for 12 consecutive months, and they do not fluctuate with the number of units that we produce. So let's use a new example. What I really like is I like to drink coffee. And whenever I get to some place or some mall and they have a coffee stand, I like to buy myself some coffee. And I think we also have a coffee stand at the Vol Mall. It is right across from the Edgars. There's a coffee stand, and I always support them and act like I'm not on a diet. So let's use that example and see how fixed overheads relate to that. If we think about something such as the factory rent, that is a fixed overhead because factory rent is normally only escalated once every 12 months. So if you rent a place, they increase it between 7 and 10% every year. But for the other 12 months, it remains the same. If we think about our coffee stand, they also have to pay rent. You can't just pitch up at the mall and sell your coffee at a stand. You need to pay rent for the area where the coffee stand is situated. And if we pay rental for our coffee stand of 10,000 Rand a month, it will be 10,000 Rand a month. It doesn't matter if we sell 1 cup of coffee, 500 cups of coffee, 2 million cups of coffee. It's not related to our output, to our production. We need to pay 10,000 Rand, and whoever we are renting from will not feel sorry for you. You can't go to this person and say, okay, this month I only sold 1 cup of coffee, so I can only pay like 500 Rand rent. No, they don't mind. There's a fixed amount of rent and you need to pay it. It doesn't matter what your manufacturing outputs are. Then we have variable overhead. So variable overheads are now the opposite of fixed overheads because they vary with our outputs. They vary with production. So what would be variable overheads for a coffee stand? Well, of course, something like electricity, because the more cups of coffee we sell, the more times we have to boil a kettle or an urn, and we will need more electricity for more cups of coffee. And if you think about something like water, the more cups of coffee you sell, the more water you will need. So some overheads are directly related to our production. If we make more, we need to incur a higher amount of that overhead in Rand terms. So the more coffee we sell, the higher our electricity bill will be. If we put our variable overheads on a graph, that is what it will look like. The more we produce, the higher the cost will be. Then there's also semi-variable overheads. So semi-variable overheads are also called mixed overheads, depending on the textbook that you are using. But these contain a fixed and a variable component. And the example that they've given in the textbook is a telephone account. And it's quite a good example, because the telephone account has two intervals to it. So normally if you have a telephone account, let's say you have a telephone account with Telkom, right? If you have a account with Telkom, you will encounter the following. So at Telkom, you need to pay an amount every month. So you pay a fixed fee to have a active phone line. And let's suppose that would be something like 100 Rand every month. So you need to pay 100 Rand every month so that they don't squash your phone line, so that the phone line remains active. Then we also have a variable fee that we pay to Telkom. And the variable fee will be based on the minutes that we use our phone for, or the minutes of phone calls. So if I now make phone calls of 200 minutes, my account will be more than the next person who phoned only for 20 minutes. So if you have a Telkom account, you will find that there's a fixed and a variable portion to this account, because the fixed portion means that you need to have an active phone line and you need to pay the 100 Rand every month, whereas the variable portion depends on the number of minutes of phone calls that you make. Right, moving along, last slide, I quickly want to talk about combining manufacturing costs. So in management accounting, we often combine manufacturing costs and we refer to it as a single term. So if we talk about prime cost, it is direct material plus direct labor. If we talk about the term conversion cost, we refer to direct labor plus the manufacturing overheads. If we talk about production cost, we talk about direct material plus direct labor plus manufacturing overheads. Quite important that you understand the concepts, because I can ask you, calculate the prime cost to produce this product. What was the conversion cost to produce product C? So if you do not understand this term, you will not be able to know what calculation goes hand in hand with it. Right, so that was today's lecture. Quite interesting, just the basics of management accounting, why it is important, what types of costs will you encounter going forward in this module. I hope that you have enjoyed this lecture. If you have any other questions, please contact the lecturers. I have posted all the contact information to Vutela. So if you have any questions, please let us know. And yes, then I am looking forward to working with you for the rest of the semester. And contact us if you do not have any other questions. I will see you in our next lecture. Please keep well until then.